Season is right around the corner, and I want to teach you the very best way to trade earnings. Hello, my name is Dale Brethauer. I've been a trader for 35 plus years, hedge fund manager. I've been a guest speaker at Money Block, Trade Monster, Investors Inspiration, Metastock, The Money Show, Value Charts, and MicroQuant. I've also written 3 financial books, and I'm very proud to be the founder of my educational website, www.optionsinfinity.com. What I do on this website is we teach how to profitably trade using credit spreads, bear calls, bull puts, combine the two and get iron condors. These are what I believe are the very best way to bring in consistent earnings. I'm teaching now not because I don't know how to do. I've done this. This is how I made my money. This is how I make my money. I get a big kick out of working with mentees and teaching them how to be a success in this very difficult arena. Every quarter we go through earnings season. This is a time when public companies announce their performance and give guidance for the upcoming months. It's an interesting time because a lot of times you'll see that a company comes very close or actually does better than their estimated earnings, but yet they get clobbered. Or just the opposite, they actually showed less earnings than was estimated, and the stock will rise like crazy. And you wonder why, and it's because the CEO, the CFO, when they give their forward guidance, that's what the big institutions are looking for. The stock market does not trade on the past. The earnings per share is what happened in the past. The forward guidance is where people are trading. So this is a highly anticipated yet nervous time for investors, especially retail investors, because they either get confirmation of a company's strong growth or news of a slowdown in revenues and profits. Now, there's another number of strategies to consider, and I'm going to show you all of these. You've got the straddles, strangles, iron condors, butterflies. I happen to believe the iron condor is the absolute best way to trade earnings. However, you need to know how wide to put your iron condor on, so the majority of the times the price will stay within those boundaries. We also want to take advantage of the implied volatility crush that happens right after earnings. You can see here's where earnings happened, and then we get the crush the very next day. Here's earning day, and then the crush the day after. Here we're going up, and the crush still occurs. And here we were going up, and the crush occurs. So we want to take advantage of that. We also want to take advantage of knowing what stocks trade and how they've traded in the past during earnings season. On this chart, what I'm showing you is that Google, it has moved on the average of 3.6% over the last 4 years. Now, it's also had excursions from 0.2 all the way up to 9.2%. And you can see in this list, you have that's been going up and going down. And here's all the percentages for each earnings season. Now, if I look at this, if I look at the times that it was less than or equal to 5% move, I get 11 out of 16 dates, and that's 69%. But if I go up to 6%, less than 6%, I'm getting 14 out of 16 dates moved, or 88%. That's what I want to look for. That's what I want to look for. Now there's 6 stocks that I really focus on, and there's plenty to be made with just those 6 stocks. Focusing on these 6 is all you have to do during earnings. Google, Amazon, Netflix, Tesla, Chipotle Mexican Grill, and Apple are historically volatile during earnings. However, I've charted and I know past history what the average move is and what the range is, and can adjust my iron condor accordingly. Now, these stocks are priced high, so you get good credit, and we need that. Google and Amazon are about $1,000. Netflix and Tesla are about $500, and Chipotle Mexican Grill and Apple are a little bit around $350 to $400. So you're going to get good credit on these guys, but also they have decent open interest, providing you with liquidity so you can get in and out with not a problem. These are the 6 I focus on. What I want to do is teach you how to do this. And this chart, what I'm showing you is the trades from 2016 to 2020. And I'm utilizing a formula here to come up with expected returns per trade, which is basically the profitable percent times reward minus the losing percent times risk times the trade size. I'm looking at a trading account about $50,000 and the trade size is only 10,000. The expected trades for the 4 years for the 6 stocks was 96. 72% of the time we have a positive return, which averages on $10,000, which is 10 full contracts. Each contract is $1,000. I'm looking at a 10-point spread. It averages winning 3,480. We only had 28% losers, and they lose less than when we win, 2,500. So every time we put on a trade, we're looking at 1805. Now that is for a pretty good size account. Let's say you only had $5,000 in your account. Well, that means you're going to trade 1 contract, and that's okay. 1 contract will give you $180.50 per trade. Now, if I want to look at the expected returns per year and staying with this trade size, 1805 times 24 trades is 43,320. And that is 87% of the $50,000 or 87% return versus the SPY last year, which was a good year in the market, returning only 15.2. I want to teach you how to do this. So what I want you to do is to click on this thumbnail to learn how to profit in the upcoming earnings season. Also, if you'd like, you can hit the subscribe button, go to my channel. I've got a lot of videos on there showing how I trade, not only in earnings, but how I trade every day. There's a lot of information there, and I hope you do subscribe. But the first thing I want you to do is learn how to trade in this upcoming trading season. Bye-bye now.